All right, so in our last session, we built the entire framework of the infinite investor. Today, we're getting into the really fun part, the engine room. We're talking about the selection process, how we actually find those incredibly rare companies that can completely transform a portfolio. So let's get right into it. So how exactly does a $10,000 investment turn into $1 million? I mean, this isn't just some hypothetical question. It's the ultimate goal for any serious long-term investor. This kind of 100-fold return, what people call a 100-bagger, sounds like a total myth, right? Like winning the lottery. But there's a specific mathematical reality behind it. It's not about luck. It's about finding a very, very specific kind of business. And here is the absolute core concept. Hitting that $1 million mark from 10 grand isn't about just one thing going incredibly well. It's about two powerful forces firing on all cylinders at the same time, multiplying each other's power over the years. You can think of it like a rocket. One engine gives you thrust, sure, but you need both boosters to achieve that explosive liftoff. So these are our twin engines. Engine number one is all about performance. The company's profits just have to grow year after year after year. The second engine is about perception. We call it multiple expansion. This happens when the rest of the market finally wakes up, recognizes how great the company is, and becomes willing to pay a higher price for every dollar of its earnings. And here's where the magic happens. When a 5x growth in earnings meets a 2x expansion in that multiple, you don't just add them together, you multiply them, and that gives you a 10x return. That is the incredible power we are trying to find.
Okay, so how on earth do we find these companies? We can start with a really practical quantitative filter, the 15-15 rule. We're looking for a return on equity of around 15 to 20% and revenue growth of about 15%. Now you might be asking, wait, why not a company with a massive 40% ROE? Isn't bigger better? And that's a great question. But think about it. A company already at 40% might be at its peak, with nowhere to go but down. A business at 18% though? Well, it has that critical room to improve, what we call a margin of expansion.
Let's actually look at the math here, because it does such a brilliant job of showing the power of Engine 1 all on its own. If a company earning a 15% return on equity reinvests all of its profits back into the business, its net worth, its book value, also grows at that same 15% rate. And you know what that means? It means the value of the business roughly doubles every 5 years. It's just a steady, relentless, powerful climb.
So, after 20 years of this, just from the business doing its thing, growing and reinvesting, our initial investment has multiplied 14 times. I mean, that is an incredible result. Your $10,000 investment just became $140,000. That is a fantastic outcome, built purely on the company's own performance. But what happens when we fire up that second engine? This is where it gets absolutely transformative. Let's imagine that over those same 20 years, the market finally catches on. It recognizes just how durable this company's growth is, and it re-rates the stock from, say, a valuation of 15 times its earnings up to 25 times. Well, that multiple expansion gets multiplied by all that earnings growth. And the result? Our total return isn't 14x, it's almost 24x. That is exactly how you turn a great investment into a truly life-changing one.
Okay, so the numbers look fantastic. That 15-15 rule seems like a really solid place to start. But this leads us to a really crucial and kind of scary question. What if focusing only on these perfect-looking metrics is actually making us blind to a huge hidden danger? What if the great numbers are actually a trap?
To answer that, we have to move beyond the spreadsheet. We need a qualitative filter. And for that, we turn to the late, great Clayton Christensen and all his work on disruptive innovation. He gives us one single, powerful question to ask of any successful company. Is this company painting itself into a corner? This question immediately shifts our focus away from how the company is doing today and forces us to think about where it's going to be tomorrow.
See, Christensen warned that successful companies often do what seems logical. They focus on their most profitable, high-end customers to keep their margins and their ROE looking great. But while that looks good on paper, they end up abandoning their lower-end customers, which leaves the door wide open for a disruptor to come in from below. These are the warning signs we have to look for. When management gets obsessed with stock buybacks instead of investing in the future, when innovation becomes boring and incremental, when the company stops taking real risks, it might be setting itself up for a massive fall.
So let's bring it all together into a unified checklist. On one side, we have our quantitative checks, the hard numbers, things like the 15-15 rule, along with low debt and low dividends. And on the other side, we have our qualitative checks, Things like assessing the company's competitive advantage, its runway for growth, and that all-important disruption risk. Now, the key here is that this is not a scorecard. No company is perfect. This is a conversation guide, designed to help us think deeply about a business.
Now, this whole checklist we've just built is designed for one thing: finding what the book calls Bucket 3 compounders. These are the core, stable, long-term holdings of a portfolio. But here's the thing: not every investment has to fit that exact mold. Some investments have a very different, much more speculative role to play.
And this brings us to this critical distinction between compounders and amplifiers. For Bucket 3, our goal is to underwrite durability. We are betting on a proven, stable business model to just keep on executing. But for Bucket 4, the amplifiers, the criteria are completely different. Here, we're underwriting optionality. We're willing to accept unproven business models and really high risk because we're looking for those asymmetric bets, the small lottery ticket positions that have the potential for an explosive 10 or 20x payoff.
So, this all leads us to the single most important takeaway. All the portfolio buckets, all the lenses we use to manage them, they're important, but they're secondary. The primary driver of your returns, the true engine of alpha, is selection. Having a rigorous, disciplined process for what you allow into your portfolio in the first place is the foundation. Without it, the entire system is just built on sand.
And that leaves us with one final provocative thought. We've just built this whole system with rules and filters and checklists, but what happens when you actually find one? A true 100-bagger. What do you do when your own rules tell you it's time to sell and take profits, but every instinct you have is screaming that the journey has only just begun? Well, that is the domain of exceptions, and that is a topic for another day.